Today, we are going to talk about a hidden psychological trap. It's something that quietly drains the accounts of so many new traders. It's a subtle bias that feels totally logical in the moment, but over time, it can be absolutely devastating to your portfolio. So let's dive in and figure out how to spot it and, more importantly, how to avoid it. You've probably heard this scary statistic before, right? That something like 90% of beginners lose money when they first start trading. So why is that number so incredibly high? Is the market just rigged against the little guy? Well, not really. A huge part of the answer has nothing to do with market mechanics and everything to do with human psychology. And the main culprit we're looking at today is a cognitive bias called the disposition effect. So what exactly is this thing? To put it really simply, the disposition effect is our brain's natural tendency to make us do the exact opposite of that classic investing wisdom: cut your losses and let your winners run. Instead, we get this intense urge to sell our winning stocks to lock in a small gain, while at the same time, we stubbornly hold on to our losers, just hoping and praying they'll get back to what we paid for them. To really get our heads around this, we've got to look at the two sides of this trap separately: the impulse to sell our winners and the refusal to sell our losers. Because it turns out they're driven by very different but equally powerful emotions. And this right here breaks down that internal battle perfectly. On one side, when you sell a winning stock, you feel this rush of pride, right? You were right. So you lock in that little profit to make that feeling permanent. But with a losing stock, it's a totally different story. That's all about hope and this deep, deep fear of regret. We avoid selling because that means we have to realize the loss, which is just another way of saying we have to admit we made a mistake. So we hold on, hoping to get even, but that often just digs the hole even deeper. So why on earth do our brains work this way? I mean, it feels so backward. Well, it's not some personal flaw you have. It's a deeply wired feature of human psychology. Let's pop the hood and see what's actually driving these really counterproductive decisions. Okay, so way back in 1985, researchers Sheffrin and Statman identified 4 key psychological drivers behind this. You've got loss aversion, and that's the big one we're going to focus on. Then there's mental accounting, which is how we treat different piles of money differently. Regret avoidance, that powerful feeling of not wanting to feel the sting of a bad call. And finally, just a simple lack of self-control, where our feelings just steamroll our logic. This brings us to the absolute core of the problem: loss aversion. You see, psychologically, the pain of losing $100 is way, way more powerful than the joy of gaining $100. It's not a one-to-one feeling. And because of that asymmetry, we do irrational things. To avoid the pain of making a loss real by selling, we're willing to take on even more risk, just gambling that the stock will somehow recover. And I love this quote because it just nails the paradox here. Getting into the market requires optimism and taking risks. But once you have money in the game, a totally different mindset is required to preserve it. Keeping your money means you have to have the humility to say, I was wrong, and cut a losing stock. And that means you have to overcome that powerful primal fear of realizing a loss. Now, this isn't just some abstract psychological theory. We have decades of research that have documented this behavior and actually calculated its very real and very high cost. The data is crystal clear. This emotional bias is expensive. So check this out. A landmark study back in 1998 by Terrence O'Dan analyzed 10,000 brokerage accounts. And what did he find? He found that investors were almost 60% more likely to sell a stock that was making money than one that was losing money. On any given day, they sold 14.8% of their winners, but only 9.8% of their losers. They were systematically selling off their best assets and holding on to their worst. And what's the long-term result of behaviors like this? Well, just look at this chart from Delbar. For decades, the average investor's return has been way, way below the S&P 500. And this gap, it isn't because people are bad at picking funds. It's what we call the behavior gap. It is literally the price people pay for making emotional decisions, like trying to time the market, and, you guessed it, the disposition effect. So let's put a real number on this. How much does this actually cost? Well, a study of Finnish investors did the math, and they found that the disposition effect alone cost the average investor between 3.2% and 5.7% in returns every single year. Just think about that. It's like an invisible tax on your portfolio that you pay directly to your own emotions. Okay, that was a lot of bad news. We've defined the problem, we've looked at the psychology, and we've seen the pretty painful evidence. But now for the most important part. How do you actually escape this trap? Well, the good news is there are concrete strategies you can start using right away. So here's a simple 3-step plan. First, set your rules before you even get into a trade. A stop-loss order is a fantastic tool for this. It's basically a pre-commitment to sell if a stock hits a certain price, and it takes your emotional, in-the-moment self right out of the equation. Second, you can reframe the outcome using a technique called hedonic framing. And third, just zoom out and play the long game. Let's just quickly touch on that second step, hedonic framing. It sounds kind of fancy, but it's really just a mental trick to manage the emotional highs and lows of trading. For example, instead of getting beat down by several small losses, you can mentally bundle them together as one single cost of doing business, and then just move on. On the flip side, if you have one big win, you can celebrate it as if you hit several smaller goals. It's all about consciously changing the stories you tell yourself so you can manage your emotions better. Ultimately, beating the disposition effect and a lot of other biases really just comes down to a fundamental shift in your mindset. It's about learning how to separate your thinking from your feeling when it comes to money. I mean, think about something like the fear and greed index. When that thing plunges down to a level like 16, it means the market is in a state of extreme fear. Everyone is panicking. And historically, those moments are often the absolute best buying opportunities. But what is every single emotional instinct in your body screaming at you to do? Sell, run for the hills. And that is the conflict right there in a nutshell. Your gut reaction versus your rational plan. And all of this brings us back to one of the most important lessons for any investor. Success isn't really about perfectly timing the market. That's a game driven by prediction and emotion, and it almost never works. It's about time in the market, and that's a strategy built on discipline and patience. Letting your winners run and cutting your losers is a huge part of that discipline because it allows time and compounding to do their magic for you. So I'll leave you with this question to think about. The next time you look at your portfolio and you're about to make a decision, ask yourself, is this part of a disciplined, long-term plan, or is this just an emotional reaction to the pride of a small win or the fear of a small loss? Seriously, the answer to that question can make all the difference in the world. Thanks for tuning in.